Welcome to IndexOrbit. Today, we are going to master a professional-grade trading system, the institutional footprint strategy. Our learning objectives for this session are: 1. You will be able to identify smart money activity using 4 layers of Confluence. 2. You will learn how to execute high-probability trades using candlestick patterns, Fibonacci levels, and volume-weighted average price. This strategy isn't about guessing where the market will go. It's about finding where the big players have already placed their bets and waiting for them to defend those positions. If you are looking for a powerful platform to apply this, you can use the referral code EJZZI96380 to join the Dhan trading platform. Don't forget to like this video and subscribe to IndexOrbit for more institutional insights. In this scene, we establish the foundation of our strategy. Layer 1, market structure. Identify the structural trend to define your trading bias. Institutions don't trade in a vacuum. They follow the path of least resistance. To find this path, we look at the big picture using the daily or 4-hour chart. We are looking for a sequence of higher highs and higher lows. When we see this pattern, the structure is bullish. This means we only look for reasons to go long. We never fight the structural trend. Conversely, if we see lower highs and lower lows, the structure is bearish. And we only look for shorts. Looking at the Nifty 50 data, we started at a June low of 23,150. Price moved up to a peak, then a higher low, another peak, and eventually reached a swing high at 24,646. Currently, price is pulled back to 24,035. Because the previous higher low is still intact, the structure remains bullish. Our bias is long. We have successfully completed step 1, defining our bias. Now that we have a bullish bias, we need to find the value zone. This brings us to layer 2, Fibonacci and the previous close. Our learning objective is to use Fibonacci retracement to pinpoint the golden pocket. Institutions often wait for price to revisit historical zones of interest to collect liquidity. They use large limit orders to get a better average price for their massive positions. Let's look at the candlestick chart from the 23,150 swing low to the 24,646 swing high. To find this zone, we pull our Fibonacci retracement tool. We click at the swing low and drag it to the swing high. This generates several horizontal lines. We are specifically looking for the area between the 0.5 and the 0.618 levels. This is called the golden pocket. For Nifty 50, this zone sits between 23,722 and 23,898. Notice where the current price of 24,035 is. It is currently above the golden pocket. This means the zone has not been tested yet. In professional trading, patience is key. We don't jump in now. We wait for the price to fall into this specific box. We have now met our second objective, pinpointing the high probability value zone. Even if price hits our Fibonacci zone, we need an intraday filter to ensure we aren't catching a falling knife. This is layer 3, the VWAP filter. VWAP, or volume-weighted average price, is the average price paid by all participants during the current session. It tells us who is in control right now. Let's look at the Nifty 50 intraday action for July 14th. The blue line shows the price throughout the day. The orange dashed line is the VWAP. Notice how price traded below the VWAP for almost the entire afternoon. This indicates institutional distribution. Essentially, even though our big picture trend is bullish, the intraday tape is bearish. Under the institutional footprint strategy, we only take a long trade in the golden pocket if the price is also trading above the VWAP. Because price stayed below WAP on this day, this framework would not have triggered a long entry. This is the strategy doing its job. The market structure said bullish bias, but the VWAP filter said not today. It kept us out of a low-quality trade during a down day. We've now learned how to use VWAP as a real-time momentum filter. The final layer of our strategy provides the ultimate smart money confirmation. This is layer 4, volume and the option chain. Identify entry triggers using volume spikes and option open interest. Price action can sometimes be misleading, but volume and real option positioning are much harder to fake. We are looking for two specific things to happen once the price enters our golden pocket. First, we look for a rejection candle. This could be a pin bar with a long lower wick or a bullish engulfing candle. Crucially, this candle must be accompanied by an above-average volume spike. This spike is evidence that large institutional limit orders are being absorbed and defended. Second, we look at the option chain. For a long setup, we want to see a heavy put wall. On the Nifty 50 chart, notice the high concentration of put open interest between 23,600 and 23,900. This is vital because big option writers are financially incentivized to defend these levels to protect their premiums. When this put wall overlaps our Fibonacci golden pocket, it creates a confluence zone. By waiting for both a volume spike and a defended put wall, we ensure we are moving with the weight of the market. You have now met the objective of identifying institutional entry triggers. Let's consolidate everything we've learned into a clear, actionable workflow for the Nifty 50 setup. As of our current data, here is the plan. Our bias is bullish because the higher time frame structure is intact. Our zone of interest is the golden pocket at 23,722 to 23,898. This is reinforced by the put wall we saw in the option chain. The entry is not yet live. We are waiting for price to trade down into that yellow box, print a rejection candle on high volume, and reclaim the VWAP. Every professional strategy needs an exit plan if it's wrong. If Nifty closes a day below 23,600, the thesis is invalidated. This would mean the major put wall and the mid-June swing low have failed. Most retail traders lose money because they enter on a single lagging indicator like an RSI or MACD. By stacking these four independent confirmations, trend, geometry, intraday flow, and derivatives positioning, we significantly reduce false signals. Take a moment to think. Are you waiting for all four layers to align, or are you rushing into trades? This discipline is what separates smart money from the rest. Remember, you can set up these charts and the option chain using the Dhan platform with the referral code on screen. We've covered the full institutional footprint strategy. You can now identify structure, find the golden pocket, filter with VWAP, and confirm with volume. If you found this walkthrough helpful, like the video and subscribe to IndexOrbit. Happy trading!